This is all about the simulator, and the simulator for the all-in-one loan is going to take a deep dive into what your situation is and how we can actually show you how it will work specifically for you. So let's give it a try and take a look and see what we can do here. So here is our simulator. This is the page that we would go to kind of show you all of this stuff. So I'm going to do a new simulation here, and we're going to show you exactly how it's going to work on a purchase transaction, primary residence, a new loan versus an all-in-one loan. Okay, so we're going to take $1 million purchase price, and we're going to take a loan balance of $800,000, so 20% down, which is a normal situation here, right? And we're going to compare it to a 30-year fixed rate loan. Let's do, interest rates are 6.75% to 7% right now. Let's do a 6.5% rate, okay? So we're going down below the market here. So here's where our payment's going to be on a 30-year fixed rate loan. It's going to end up being just over $5,000 per month, all right? So we know that is true. That's what the numbers are going to be. And so we're going to go here, clear the screen. Now, this is where the monthly income comes in here. This is net income that's going through your checking account on a weekly, monthly, whatever it is. We can do that and specify for you. Right now, I'm going to just limit it to $15,000 a month that goes through your account on a monthly basis, and that's it. We can show you one-time deposits of large amounts of money. We can show you quarterly payments, annual payments, whatever it is but it's the net. It's the net number that's going through your account, not your gross number. So it's after taxes that's going to go through your account. So that leaves you with deposits of $15,000. We're going to take out a mortgage payment out of these numbers of $5,000 a month. We're going to take out your taxes and insurance of about $1,200 a month. That leaves you with about, $8,000 per month. Let me clear that. So it leaves you with about $8,000 a month. Now, the key here to this loan is what's left over in your account on a monthly basis, right? So if we take this number, we normally are going to show 15 to 20%. I'm going to keep it at 15% on the low side. That means that you're leaving about $2,200 in your account each month, and you can only spend about $6,400 a month on gas, electricity, utilities, food, anything that is disposable income. That's what you're spending, $6,400 cash each month, car payments, etc. Now, it goes fast, but the key here is what's left over, that $2,200. So the more that's left over there, the better the numbers are going to be on this particular loan. So now what we're going to do here is we're going to show you the results on a 30-year fixed rate loan. I've showed you in some of the other videos the interest on these loans. You pay it over 30 years, you're going to pay more than double what you paid for the house in interest. In this example, you're going to say principal and interest over 30 years, $1.8 million on this loan. Now, on the all-in-one loan, you're going to save $308,000, and you're going to pay it off in 17.3 years. Now, this is without doing anything different, just your normal paycheck. The paycheck that your income is probably going to go up over time a little bit. At least a little bit it's going to go up over time. There's going to be more money going through your account, and you can pay this loan down faster. Now, this is a variable interest rate loan, so it could change. On this particular example that I'm showing you, I'm going to show you some of the assumptions. One is we're showing you an 8.352 rate. That is a combination of a margin and an index. This is an adjustable rate loan. It changes every single month. Now, I would say to you that right now this is a little bit high of an interest rate. I normally give you a little bit lower interest rate, but we charge you for that. So we go down to a 2.75 margin. That brings your rate down to the 7.102% as of today. How this changes is the index. So as the index changes, this rate will change. So this is the variable part of the loan. This is the fixed portion of your interest rate. So that's the fixed portion there. So as the index changes every month, your interest rate will change. But we're going to stick with this here. Now, this is remaining. We put here the rate trend, remaining at the initial rate for the entire term of the loan. So we're going to update this. So remember, you were saving $300,000. You're now saving over $500,000 in interest on this loan and paying it off in 14.8 years. That's if interest rates stayed the same for the whole 14, 15 years of this loan. Okay? Now, let's go back again here, and let's just say that it goes to the historical averages, which I don't think it's going to be the historical averages anytime soon. But if it did do that, you just paid it down by another 3 years faster, and you're saving over $730,000 in interest by paying this loan off sooner. So these numbers, they are big numbers. The higher the loan amount, the bigger the numbers are going to be. The faster you're going to pay off this loan, the more income that goes through your account, the better this is going to be. So this, again, this is a completely different look than a 30-year fixed rate mortgage. But if you call me today, I'll schedule a half-hour call with you. You can save $200 on your closing costs by just calling me to go over this. And when we close your loan, I'll give you $200 off on your closing costs. So at a minimum, subscribe to the YouTube channel here, and we can show you more and more content as to how you can benefit from using this all-in-one loan. So if you have any questions, please feel free to give me a call. Again, subscribe, hit the subscribe button, and let's get you educated on the all-in-one loan.